John, it's good to see you this morning. We're recording this on Thursday, the 24th. What a topsy-turvy month it's been. Since President Trump's so-called Liberation Day on the 2nd of April, we've had markets all over the place, and I'm sure what investors want to know is this correction over? Is it the start of something larger? Where are we at the moment, John? Do you have any sense of whether the worst is over, or we're in a process of readjustment that might continue for some while yet?
Well, it's very hard to read, Paul. I mean, it's quite apparent now that the US administration went too hard and too quick. And what we're seeing is them negotiating back with themselves, given the market pushbacks. The equity market fell dramatically from an overvalued position, admittedly, but it's quite apparent that particularly the head of Treasury is watching the markets, trying to soothe the markets, and therefore the market is negotiating with the administration, not so much international prime ministers. I think we've got to start saying that the Trump dialogue is very overstated, and it's just going to be interesting to see how this plays out. That he's created havoc. He needs to unwind it and get back to a proper diplomatic negotiating position, which is very hard for him to do, given his nature.
So we're now at the stage where a lot of economic forecasts are being kind of ratcheted lower in the expectation that, the tariff uncertainty is going to really affect growth prospects. The IMF has released new forecasts a day or two ago, suggesting that although America might not go into recession, their growth forecasts have been reduced materially from just a couple of months ago. It seems like the soft data is all very much weaker, but we haven't really seen that showing up in the hard data yet. Is that just ahead of us and it's a matter of timing, John?
Yeah, well, the international agencies are doing what you expect them to do, which is downgrade, given uncertainty, and they are economists. I think they're guessing at present, because you've got to guess that the tariffs, you've got to make an assessment, are they going to be fully implemented at a high rate or just put in place at 10 to 20%? A 10% tariff will have some effect on growth, but not significant. A 20% plus will have significant effect on world growth as the world adjusts. So it is a lot of, I think, speculation, but the trend line is for slower growth around the world whilst this negotiation takes place. And then you've got to start working out, is it really going to solve America's deep-seated debt problems in terms of its government debt and its fiscal budget, which is 6% in deficit? Is this going to be enough to rectify it? And I think the view is that it won't be. The rectification is going to take a decade. Not going to happen overnight. And this is probably the problem with Trump's policies: is he doesn't understand the embedded nature of the supply lines which come into America. I think he's got feedback already from the major international companies in America that it's just not going to work for them. And that's why he's had to backtrack. So we're in a state of limbo, Paul, but we can say world growth will slow. That's about all we can say.
Well, let's turn to Australia. I know the IMF is just another group of economists trying to make their own forecasts, but they have reduced expectations of growth in Australia down from, I think it was 2.1 for 2025, that they came out with in January. Now they've pulled that back to 1.6. So 0.5% reduction in growth expectations for Australia. If we look at over the last month, our ASX 200 dropped about 10% from 8,000 down to 7,300. We're now back close to 8,000 again. Are prospects for Australia probably a little bit better than we would have thought a few weeks ago, or is the pain kind of still ahead of us?
I think the IMF and some of the forecasts are just doing a broad brush, so everything gets downgraded. It's too quick. They haven't thought it through. I think other think tanks have said that the implementation of tariffs between America and Australia have very insignificant effects. That the bigger issue is there a slowdown coming in China, which is then reflected in imports from China of Australian commodities. There's no indication that that's occurring at present, given the embedded nature of the supply lines of China into the American multinationals and their manufacturers and distributors. It'll just be a cost impost put onto the American economy without a significant dramatic effect on the Chinese in the short term. So
Yeah.
I tend to the view, and let's put the other side of the argument for Australia, is we've had population growth, which is going to compound through the economy as these people assimilate into the economy, into employment, into consumption. We've got a expansionary budget into deficit, and the deficit forecast is circa 1% of GDP. So having economic growth of 0.5% above the deficit doesn't seem realistic. And we've had an election where there's more promises coming for stimulation. So I think the IMF's wrong. I'd be surprised if our growth is not superior to America's in 2026.
And we're seeing quite a lot of activity on the share market in terms of individual stocks either outperforming or underperforming. We've spoken so many times about CBA, and it's being priced at on a multiple of about 26 times, about double what it has historically averaged. Hit a new all-time high, I think yesterday, of $167, something like that. Are you worried that, superannuation monies are being forced into index following, which are pushing the CBA artificially high? And, what are your thoughts about it hitting a new all-time high like that?
Well, you'd be concerned if you're an index investor. The good news is that it's pushing the index up, so you're a winner. The bad news when it corrects. And if people don't think it's going to correct, I just reflect on the 20% correction in the S&P 500 and the 25% correction in the Nasdaq in 6 months from their peaks. Both those indices, particularly the Nasdaq, I did some work recently. The top 7 stocks, the Magnificent Seven, had a market cap late in 2024, $17 trillion. Over 50% of the American GDP represented by 7 stocks. Now, when you look at market caps to GDPs, you usually have a rule of thumb. It should be, I think Buffett has said, and various other ratios, other commentators, experienced commentators said, around 110, 120% for the whole market to GDP. So when you get 7 stocks representing well over 50%, that's a worry. And those stocks were trading at their peak at 9 to 10 times revenue, not earnings, revenue. And when you combine the whole 7 stocks, it was 30 times profit, over 30 times profit. So coming back to Australia, Commonwealth Bank trading at 26 times and representing 12 to 13% of the index. And probably its market cap now is heading towards 8 or 9% of Australia's GDP. And it is a purely domestic company. It doesn't have the benefit of those Magnificent Seven, which are international companies and trade off international growth. It is a very significant issue for Australia's index. Now, I just want to finish on this point in terms of talking about Commonwealth Bank. There's no doubt there's been a capital strike of some sort by international investors in the American capital markets, including equities. A rediversion of capital inflows into America, out of America into other markets, leads to it coming to places like Australia. Not big numbers, but a revaluation of the Australian market in terms of international international investors, a preponderance of that goes into the index, and the preponderance therefore goes into the Commonwealth Bank. Now, until you get thinking investors who say, I want to buy Australia's growth and I want to start picking the market, the first wave of money is indexing and the second wave will be more thoughtful. So very hard to predict, but I think there's a lot of reasons why the Commonwealth Bank's performing against logic, okay? But let's assume logic will take over, as it did do in the American market in the last 6 months.
Well, John, since we last spoke, probably about 3 weeks ago, because I've been on leave, the federal election picture's completely changed. A month ago, it looked like the coalition was the favourite to win. Now it looks like Labor's a 80% probability to retain government. A big part of the campaign is focused on housing and the cost of housing. Have you got a sense of the various policy proposals and what that might mean for residential property prices in Australia, which is obviously a really key issue?
Look, I think the policies just support price. They don't support a solution, and that's a real problem for Australia. I keep on reflecting. The issue in America today is government debt. The issue in Australia is household debt. What America is facing today will soon come to Australia, but it'll be focused on the household sector of Australia, and particularly young families who are heavily geared into the housing market. The policies by both sides just support more price rises. There's nothing on the supply side, and there's nothing to get the price of housing down, which is the scary thing. The housing market will correct at some point. We can't predict when and how, but it will correct. And at that point, you will have to see the government, doesn't matter who the government is, come into the market and really refinance that part of the market which is overgeared into the property market. And I foresee a situation where the government comes in and takes over the leverage part of the housing market and takes it into the government sector. I can expand upon that. This is not the time, but that's what's going to happen. And probably to preempt it, it would have been better off the government doing that now, saying, look, rather than saying to the banks, as the Labor Party's done, oh, look, let's get people borrowed to 95% of value with a 5% deposit. That's exactly what the problem was prior to the GFC around the world. It's a feel-good policy for people who are struggling to get into the housing market, but it's a disaster longer term. The Liberal Party or coalition in terms of tax deductibility of some rentals makes more sense to me. But, it needs to be part of a total solution. These piecemeal throwaways are going to make the problem worse, not make it better. And the problem is affordability and debt against that affordability. It's a big issue, and it's appalling in this election campaign. It hasn't been properly addressed, but probably it's not the forum to do it, where you've got two sides trying to fight for government.
John, I've mentioned a few times that this month has been truly extraordinary. So what we've seen is the volatility index, the VIX, which peaked at 60, is now below 30. We saw the Australian dollar under extreme pressure, hitting under 60 cents. It's now back close to 64. We've got yielding stocks like Telstra and some of the banks performing very well, whereas consumer-facing stocks like Woolworths and some of the others are not performing well. So there's a lot of patchiness. Is this an environment where you really have to focus on fundamental attributes of companies, be conservative, pick the eyes out of those companies that are particularly resilient in this environment, and get away from indexing, as we've said? So it really should be a very good period for active managers.
Look, it's a trading market, Paul. Look, you never get away from value and thinking sensibly, so I take that point. But I just think the volatility opens up the trading opportunity. Investing, fine. If you're taking a very long-term view, you always let your income come in, and if you pick the right stocks, reinvest when you can, But the volatility on display, and particularly the volatility in the American market, the Australian market's been volatile, but to some extent, on certain days, it's been resilient against the American situation where the market's been going up and down intraday 2, 3, 4%. And again, last night, it leaped out of the barriers and still it was up about 4% at one stage and ended up about 1.5%. I mean, that sort of volatility is ridiculous. I've published a little report on LinkedIn if people are interested, and we may publish it more widely, that I think I've been saying for years the American bond market's not fit for purpose. I think now the American stock market is exhibiting issues, particularly about extreme speculation, and we can talk about insider trading and the ramping of the market by the US administration, which is being reported in the press. The head of Treasury privately briefing fund managers and hedge funds managers at JP Morgan offices is a disgrace. That sort of thing is being outlawed in Australia. To see it being published in the press that he has been giving private briefings is extraordinary, and then the market reacts. And that suggests to me the American stock market is becoming not fit for purpose until it stabilises. That leads to volatility. That throws up opportunities if you want to trade against the grain. But in terms of logical investing, I think this environment is for diversification. And I've been pushing the diversification argument for quite a while now, but I'm adamant now that, that the argument between growth and income, I think you'd be slanting more to income. If that's available in the share market, great. But the sustainability of income in the share market has to be questioned. I guess down to your research argument, Paul. There's a lot more sustainable income off the share market in corporate debt and mortgage facilitation, some hybrids, convertible debt, in the private markets where you're getting much better yield. And let's just look at the forward yield curves. We've got a situation in Australia where the forward estimate is that the cash rate is going to trend towards 3% this time next year. I think that is possible, but maybe a bit bullish. The American interest rates are probably going to be cut by 0.5%. Whether power's there or not, that's another issue. So we've got a declining interest rate environment coming in a slowing world growth situation, but we've still got pretty attractive yields in the unlisted market. So that's something I'd suggest in terms of my thought process. Weight more to income, but be well diversified.
Well, that's a good point to end on, John. Thank you very much. I think we'll call it there. Tomorrow is Anzac Day, so we wish everyone a good long weekend, and we will see you next week. Thank you very much.
Thanks.